Welcome to It's the Economy. Today, we look at the state of India's private capex. A MoSPI survey, Ministry of Statistics survey, first of its kind, published on April 29th, said that private capex in India grew by 66% over 4 years, from FY22 to FY25. That survey also said that capex will decline this year. Also, the central government capex, after 3 years of hectic spending, will grow more slowly in the current year, as we know from the budget. An S&P Global Ratings report says that India's private capex will nearly double to $800 billion from now to 2030, that is FY25 to FY30. Now, one of the most accepted authorities on capex projects in India is the CMIE. So today, to discuss the themes, I have with me Mahesh Vyas, Managing Director and CEO for the Centre for Monitoring the Indian Economy, CMIE, and Neel Gopalakrishnan, Director at S&P Global Ratings and author of the report I just referred to. Gentlemen, I think I have the two best experts on private capex. Thank you very much for joining me. Mahesh, you tell me, what is the state of capex? Your elaborate table that you gave me over the last 10 years will run as you speak. I got the sense from that projects announced are rising, but projects completed are not rising that much.
Well, there's always a big lag between the project announcements and projects completed. But, if you look at the 10-year horizon, and for investments, one needs to look that at a horizon, there is a significant increase in capex in India. So we have nearly a doubling, not a doubling, but a near doubling of investments, whether it is in announcements or in completion. So we used to have about 20 lakh rupees worth of new investment proposals being made every year till before the pandemic.
Yes.
After the pandemic, that number is nearly 40 trillion. So 20 has become 40, which is a kind of a doubling. In the last 3 years, you look at the numbers like 41 trillion, 36 trillion, 42 trillion. So there's a little blip up and down, but nevertheless, these numbers are clearly double of what they used to be. If you look at total completions also, you have like around 5 trillion rupees worth of completions happening before the pandemic. And there were lots of ups and downs, too much of noise. But nevertheless, what we have now is closer to 8 trillion, maybe 7 trillion, 7 to 8 trillion thereabouts. 24-25, we saw a small fall to just 6 trillion. Number may get revised a bit, but still, it was a little slowdown. Nevertheless, if you look at the long picture, both the numbers have gone up significantly, whether new announcements or their completions.
Okay. I take your point, and those numbers were running as you spoke. New project proposals were averaging about, as you said, 20 trillion before 2019. And in the last 3 years, the average is about 40 trillion, the projects announced. That is clearly the case. But if you adjust for inflation, it doesn't look like the number of the actual amount is very good. And especially when you look at completion, where the difference is not very big. Around 5 trillion has become about 6 trillion average in the last 5 years. If you adjust for inflation, it doesn't look very big, no?
Well, you are right, Latha. If you adjust for inflation, it doesn't look very good. But, for a long time, the investment story was so depressing that we are so pleased to see this doubling, even if there is inflation. Mind you, inflation has gone down. So you have to adjust less for inflation now compared to what you had to do earlier.
That's a fair point. That's a fair point, especially because in these cases, we may have to adjust with WPI, and that has genuinely fallen to very low single digits. So point taken, something to celebrate in private capex projects, announcements and completions. That's the word from CMI. Neel, I have this very optimistic report of yours for FY26 to FY30. Can you just give us a word on whether you looked at anything in the previous years, like up to FY26, anything at all that, you saw?
Hi, Latha, and thanks for having me on your show. So the way we came up with our estimate was a kind of a bottoms-up approach where we looked at some of the largest companies. We looked at the announcements made by the 100 largest listed companies in India, and this was across sectors. And to that, we added some of the large unlisted companies, many of which we rate as well, and also looked at a study on Capex done by Crisil Intelligence in India. So what we looked at was essentially the guidance on capital expenditure, which is more short term. Typically, companies give this for a year or two. And we also looked at some of the announced capacity targets of companies over the next 5 years. And that's the way we worked our Capex out. And as our study showed, a large pickup in private sector Capex is actually coming from the infrastructure sector, where we expect Capex to double in the next 5 years, whereas the industrial sector, which is the traditional steel, cement, and some of the other sectors like telecom, their investments will rise at a much slower pace, on average about 40 to 50%.
Okay. Let me stop you there and come back to you with some red flags. But Mahesh, your any reaction to this? The point that Neel's report makes is that they expect it to double, partly because there are very obvious announced instances in power transmission, airports and aircraft. I mean, those are very obvious. And then there will be the other organic expansions. Plus, they point out that balance sheets are very clean now. Both of the lenders, that is the banks and the corporates, which will do the investing. And that's how they base their doubling of Capex. Your thoughts?
Well, I haven't seen the Crisil report to actually make a fair comment on that. With that disclaimer, I may say that to the last point you made, that the balance sheets are very clean. Companies can easily gear a lot more. Their profits have been superb in the last several years. Their debt equity ratio is extremely low. Interest cover is extremely healthy. So the balance sheet of the Indian corporate sector is super. And the banks are also in a good place to lend. But this story has been true for a very long time. And investments by listed companies and large unlisted companies is a very depressing story. Oh. So I did a little study a few weeks ago, and found that if you look at the growth in net fixed assets, outstanding net fixed assets between 2006-07 and 19-20, there was a certain growth rate, and that growth rate has halved since then. So, although profits have multiplied multiple times, it's not a percentage increase, it's a multiples increase in profits. But net fixed assets today is growing at 4% per annum nominal terms. So the balance sheets don't give me any great confidence that the Indian corporate sector, listed or unlisted, and I'm talking about a sample of 30,000 companies accounting for a very large part of India's GDP. So that's not...
Okay, I take a point. So what the very good or very heartening bar chart that we played of yours, that total investment proposals have gone up from an average of 20 trillion in the 2010 to 2020 period are up to now 40 trillion. That is largely government capex then. It's not so much private capex?
Yes, a large part of it is government capex and infrastructure and not manufacturing. Infrastructure is largely funded by the government. So you see, government, or rather infrastructure, accounts for nearly 60% of all investments in India. Okay. Manufacturing is only around 26% or 30%, thereabouts.
Okay. Let me come to you, Neel, on that. On your optimistic analysis of 25 to 30, there are two red flags. One, that government capex will slow. I mean, during the COVID years, we saw that 30% rise and then a 15% rise in government capex. Clearly, FY26, we are seeing a little bit of a pullback. It can't grow because the fiscal deficit has to come down. So would that be a big red flag? And of course, this tariff picture, Chinese dumping, overcapacity, can these two stymie your number?
Right. That's a valid question. And at any point, you would see significant fluctuations if your period of analysis is relatively short. So if you're looking at maybe year-to-year comparisons, you would see a big rise in a year and subsequently, and similarly, maybe sharp falls in some other years. But in our study, what we have looked at is the actual private sector capex in the last 5 years versus what we think would be a potential capital expenditure investment in the next 5 years. So the investment period is relatively longer.
Okay.
And just responding to Mahesh's point, I think it was an interesting observation, and I agree there have been implementation challenges once companies announce projects. But what we have noticed is most of these, and that's something we have highlighted in our report as well, that particularly in the renewable energy space, which is where a significant amount of the incremental investments are coming in, there are material execution risks. But our observation is in the industrial sectors, like say steel, cement, companies have overcome this, and their ability to actually deliver complete projects in time has significantly improved. So for example, if you look at the leading steel companies, I think their execution record is pretty impressive. If I go back to renewable energy, the 500 gigawatt target appears challenging. And if you look at execution over the last few years, it's fallen well short of where it needs to be. But again, if you look at the recent trend, the last year, at least the industry has been able to add about 25 to 30 gigawatts of capacity, which is probably double what it was in the previous year. And if you look at projects under implementation, it's in excess of 100 gigawatts. So I think progress is being made. There are risks, we don't deny it. But as I said, our numbers are based on guidance from companies, targets given by companies, and there could be a slippage here and there, delay here and there. But we think the ability to execute is improving.
Is better. No, I agree with your ability to execute. What has stymied us in the past is also, for instance, in the power sector, DISCOM's not paying. And while it is somewhat resolved, it is not fully resolved. And now you have a new problem. There are companies telling us that Nal Se Jal projects in the last 1 year are not being paid for. So, you know, those government-dependent projects are still creating question marks. But as you say, some execution risks are perhaps resolved. For instance, NHAI only gives you completely acquired land. So that way, the land acquisition issue has been stopped. Final question to you, Mahesh. Would you go with this positive assessment or would you give a lot of weight to the worry that we are in a tariff-ridden world, a strife-ridden world, and that usually, it takes a brave CEO to put money when you don't know which product will be taxed how much in which country?
I would be cautious, and I think I'm always cautious. I'm cautious because most of the manufacturing industries, which are large capex, like steel is, I think, the biggest, where investment is happening in manufacturing. And that is susceptible to price changes, to dumping, to tariffs, and so on and so forth. So our biggest investment in manufacturing does face challenges. Our investments in manufacturing, to an extent, is problematic. I would expect CEOs to be circumspect and not be too gung-ho and going and setting up very large plants at this stage. Fortunately or unfortunately, manufacturing accounts for only about 25 to 30% of our investments. So less of a risk over there. Infrastructure can continue.
Yep. Yeah, infrastructure can continue. That should not logically be bogged down by any tariff war. It's a very domestic industry. Gentlemen, thank you very much for enriching our understanding of a very, very complex topic. The positive that we got from CMIE is that the amount of project proposals have doubled in the last 5 years compared to the previous 10 years or previous 6 years. And likewise, project completion are also up by about 40%. S&P Global Ratings believes that the capex in the next 5 years is going to be double what it was in the last 5 years. But both of them admit that there are red flags on the horizon. We have to keep our fingers crossed. A lot of policy issues itself can stymie these. On that note, we wrap up on Bazaar. Chartbusters coming.